There's this pattern in the crypto world that repeats itself almost like clockwork, but it happens just beneath the surface, where most people aren't looking. It's the story of how the biggest players in finance, the real heavy hitters, get ready for one of Bitcoin's most important events. So, let's pull back the curtain and break down their playbook.
Think about it. In a financial world that's famous for being chaotic and unpredictable, what if there was one event, just one, that was completely guaranteed to happen? Something so certain it's literally written into the code, letting the smart money plan their moves years and years in advance. What would that be?
Well, that event actually exists, and right before it happens, this incredibly clear pattern always seems to emerge. While the headlines are buzzing about other things, the big players, we're talking about the major institutions, are quietly, methodically buying up Bitcoin. This right here, this is their pre-halving playbook in action.
Okay, so first things first, a quick refresher on the event that's at the center of all this, the halving. It's not some random market swing. It's baked right into Bitcoin's DNA. Roughly every 4 years, the reward for mining new blocks of Bitcoin gets sliced in half. This means the creation of new Bitcoin slows way down, making the asset, you guessed it, more scarce. It is a supply shock by design.
So that brings us to the real million-dollar question. Why do these financial giants care so much about this? Well, it all comes down to a simple but incredibly powerful idea: the logic of scarcity.
And this quote, this really gets to the heart of it. If your job is to manage billions of dollars, your number one enemy is uncertainty. Predictability is your best friend. And the halving, it is hands down the most predictable supply event for any financial asset in the world, period. And that's a feature that institutions simply can't afford to ignore. Their math on this is actually pretty straightforward. They see that the supply of new Bitcoin is about to get slashed. They look back and see that historically, this increase in scarcity has driven the value up over the long term. So the strategy becomes crystal clear. Get in before that supply shock hits to maximize your potential upside. It's just simple economics.
Here's probably the easiest way to think about it. Imagine we knew with 100% certainty that 4 years from today, every single gold mine on planet Earth was suddenly going to produce 50% less gold. What would you do? You'd probably start buying gold now, right? Before it gets harder to find. Well, that's the exact same mindset institutions have with Bitcoin before halving.
So knowing why they're buying is one piece of the puzzle. But understanding how they managed to acquire so much Bitcoin without sending the price to the moon overnight, well, that reveals their real strategy.
Yeah, these big institutions aren't just logging into a retail app on their phones. They operate through much more sophisticated channels. The new spot ETFs, of course, are a huge public gateway now, but behind the scenes, a lot of action happens on over-the-counter or OTC desks. That's where they make massive private purchases that don't immediately rock the public market price. They also use specialized custodian platforms for secure storage and, in some cases, even buy Bitcoin directly to hold in their corporate treasury.
And this really highlights the two completely different worlds we're talking about. The institutional game is preemptive, it's planned, it's patient, just a slow, steady accumulation over time. It's basically the exact opposite of the typical retail reaction, which can be much more emotional and usually kicks in after the hype has already started. In a way, what they're doing is front-running the FOMO.
Okay, so how can we actually see this happening in real time? Is it all just secret backroom deals? Well, the good news is this quiet accumulation leaves footprints in the data. You just have to know where to look.
So here are the key signals you want to watch for. First, and most obviously, you look for massive amounts of money flowing into products like the ETFs. Second, you watch for on-chain activity from the whales. These are the largest wallets on the network to see if they're getting bigger. A third, and this is a huge one, is watching Bitcoin move off of exchanges into cold storage. That's a huge sign of long-term belief, not short-term trading. And finally, you can track the overall supply being held by long-term holders, which really shows the conviction in the market.
And look, this isn't just some abstract theory. In the months leading up to the 2024 halving, we saw it happen right before our eyes. The new spot ETFs from giants like BlackRock and Fidelity experienced a literal tidal wave of capital, with billions and billions of dollars pouring in. This was the playbook executing in real time for the whole world to see.
So let's just run through the checklist for 2024. Billions flowing into ETFs? Yep, a definite check. Corporations adding more Bitcoin to their balance sheets? Check. And aggressive accumulation from the biggest wallets on the network? On-chain data confirmed it? Check. The playbook was executed to absolute perfection.
So, what does all of this mean for the future?
If this pattern holds true, and there's every reason to believe it will, the lead up to the 2028 halving could be on an entirely different scale.
So, what could really ramp up demand next time around? Well, the US ETFs were just the start. Imagine similar products launching in major markets all over the world. Imagine more nation-states deciding to add Bitcoin to their reserves. And then there's the biggest pool of capital on the planet, pension funds. We're talking trillions of dollars potentially making their first, even small, allocations.
It really all boils down to a very simple but incredibly powerful equation. You have a massive potential increase in demand from all these new players colliding head-on with a scheduled, guaranteed decrease in new supply from the halving. What that creates is something you could call accelerated scarcity.
And that really leaves us with the final thought to chew on. Every 4 years, that slice of new, available Bitcoin gets smaller and smaller. And as more and more of the world's biggest financial players decide they need a piece of that shrinking pie, you really have to ask yourself, what happens when a tidal wave of demand chases an ever-shrinking supply?
Subscribe and visit Web3 Newswire for visibility and credibility of your Web3 projects.